Okay, let me, since it is, so Madam Alexia, please read for us since you are the only lady in our midst.
Okay, so question 1.
Okay.
Question 1. If a capital of a business is $140,000 and liabilities are $80,000, calculate the total assets of the business.
Okay, so let's pick the data from this question. Thank you very much, Prof. Alexia. We were given the capital, which is how much? If you can give me the figure again. The capital was given as how much?
$140,000.
Okay, so 140,000. And we're given liabilities also to a tune of how much?
$80,000.
$80,000. Good. So we are asked to find the assets. The asset. So this one you don't have to waste time. You just have to code the formula. Asset equals capital plus liabilities, and you put in the figures, which we have $140,000 plus the $80,000, and you are going to get a beautiful figure, $220,000. So this was an easy one for all of you, right? Okay, now let's go to question number 2. So question number 2, let's read it. I don't know, Prof. Alexia has done it. Prof. Bishop, can you read it for me?
Okay.
Okay, I think Prof. Bishop is reading, but we could hardly hear him.
Calculate the total asset. If
Okay.
$25,000. Revenue during the period is $50,000. Expenses during the period are $40,000.
Okay, thank you very much, Prof. Bishop. Prof. Israel, I see you are struggling with your internet, but don't worry. I would share the recording later. Okay. So in the second question, we're given capital to be $40,000. We're also given creditors to be $25,000. And then we also had revenue to a tune of $50,000, and finally expenses. Okay, so these were the information that we were given. Okay, so you are asked again to calculate the assets, right? Now, in this case, you have to acknowledge the revenue and expenses and apply the extended version of the accounting equation, which I gave, or which is assets equals capital, which is affected by, so plus in a bracket, your revenue minus your expenses, and plus your liabilities. So you have to use the extended version of the accounting equation in this case, because we have these elements, revenue and expenses coming in, right? Good. So your capital is here, 40,000. Your liabilities, of course, the creditors here is our liability, and then we have our revenue and then expenses. So we can fix the figures in there to calculate the asset. So we had capital of 40,000 plus, in a bracket, our revenue was 50,000 minus expenses of 40,000 plus our liabilities of $25,000. So what we are basically doing is that we are looking at the profit the business made by way of comparing the revenue to the expenses. And in this case, I think the business is making a profit of 10,000, because revenue is 50,000 and expenses are 40,000. So the business is getting a profit of 10,000. And I told you that profits increase the capital. So this profit of 10,000 would increase the capital from 40,000 to 50,000. Added to the liabilities, we are going to have total asset to be equal to $75,000. $75,000. So this was the expected answer, and I think one person scored all, and that's great. So we hope that next time. So it's very important to note the extended accounting equation. I'll pause for any question on this before we move on to the business of the day. So Prof. Alexia, Prof. Bishop, Prof. Richmond, any question for me?
Sir,
Yes.
I think the mistake I did was using the balance sheet to solve the question.
Okay. So in case you wanted to use the balance sheet to solve the question, it is possible. You can use the balance sheet, but then the revenue and expenses are not balance sheet items. They go into a financial statement we call the profit and loss account. Okay. What goes into the balance sheet is the profit or the loss. So if you wanted to prepare a balance sheet, this is how you could have gone about it. But in this case, I wouldn't even recommend, using the balance sheet, because here you are being asked to calculate or determine assets. So you just quote the formula, okay? But if you still wanted to apply the balance sheet concept, then in this case, this is how it's going to be. So let me show you how that will be done. So we would have written balance sheet as at, because we're not given any date, we just put anything there like that. And then we want to look at our assets, okay, which we are yet to determine, should be equal to our capital plus liability. So here you can use the horizontal method or the T account method. So let me insert a table here so that we can see how that is going to roll out. Okay. So this is my balance sheet. Okay, so I can put my assets on the left side or the right side. It doesn't really matter. Okay, the balance sheet is not an account. It's just a statement. Okay, so I can put my assets here, which I'm yet to determine, and put my liabilities and capital on the other side. So here my liabilities were the creditors, right? So liabilities, I have the creditors. which was given as 25,000. And then we're also given the capital. So capital, right, was also given as, let's check our data. Capital was given as 40,000. So I can keep that here, 40,000. But then the revenue and the expenses cannot appear on the balance sheet. What should appear on the balance sheet is either the profit or loss. So what you can do is to do workings, okay? Go and calculate your profit. So when I say do workings, that is what I mean. You do something to calculate the profit. So you can tell us here that profit is equal to revenue minus expenses. Minus expenses. Okay. And as we have done here, the revenue is 50,000 minus expenses of 40,000. So we have 50,000 minus 40,000. So we are going to get a profit of $10,000. So the profit is what is added to the capital on the face of the balance sheet. 10,000. Okay. So now you can use the principle of my liabilities and capital should be equal to my assets here. And so when we add the liabilities and capital and the profit, we are going to get a total of 75,000. So a total of 75,000 here, which should be equal to the assets, 75,000. So this is how possibly you could have used the balance sheet to do that. If you wanted to do the vertical way, you just show the assets first before bringing in. But my recommendation is that quote the formula, okay, and then just fix in the elements given with the amount given as well and calculate your assets. So Prof. Bishop, I think that will be my reaction to your question. Any further questions? Okay, good. So let's move on to the business of the day. Now, the general impression I had was that your teachers tried to, make you so happy with the subject. So a lot of technical things you were not introduced to. Okay, so this is what I'm going to do. So we are taking on the double entry principle, which goes with the accounting equation as we have just revised. So the focus now will be on the double entry principle. Okay. It will be better for us to, get to know this principle since it's a fundamental principle in this subject area, right? Okay, so by the end of the lesson, we should be able to state the accounting equation, which you have done, so we wouldn't worry ourselves over that. We should define the elements of the accounting equation. You have done that. You know the assets, the liability, capital. Maybe I'll speak about the expenses and revenue or income, since that is a bit new to you. And then illustrate the basic format of the balance sheet. So majority of you have done the balance sheet. And then to the most important things, look at the effects of business transactions on the accounting equation, which will lead us into the double entry principle to get ourselves familiar with what an account is, the types of account, and how to use the double entry principle to record business transactions, balance of accounts, and finally extract a trial balance. So we've got a quite a lot of things to do, I should say. Okay. So are we ready to roll? Good. So let's move on. So I won't spend much about the account. about the accounting equation because you know this. I've added on the extended version, so please pay attention to the extended version. Okay, so definition of asset, those things you have done them. The basic format of the balance sheet. Yes, so like I was showing, you can go, this is the vertical format. Okay, the vertical format where you show your assets as against your capital and liabilities. Or you can go the horizontal way where you seek to use a T account structure with a left side. So there's the left side and there's the right side, right? Okay, but you see, balance sheet will be dealt with more as we move on. Okay, so now let's look at the effects of the accounting or transactions on the accounting equation. Now, like always, I'll make this very practical. So I'm going to cite scenarios and then you think deep about it and, give me responses. Feel free to share whatever you have in your awesome brain. So if I'm to take you as a business, so see yourself as a business. So business Alexia, business Bishop, business Israel, and business Richmond. Now, if business Alexia goes to the market and buys a computer with money or cash, let's look at what is going to happen to business Alexia. So business Alexia goes to the market, let's say Malcolm, buys computer with 5,000 Ghana cedis. Can you tell me what is really happening with business Alexia? In terms of, is the business gaining anything and is it losing anything? So who is going to do the analysis for me? Okay. Prof. Bishop has his hands up. Prof. Israel, is your network okay now? Can you share any idea with us? Okay, Prof. Richmond too is ready. Okay, let me pick Prof. Richmond.
Sir, please increase in asset to the computer and decrease in asset to the cash. And decrease for the asset which is the cash.
Okay, thank you very much. Let me hear from Prof. Bishop as well. Thank you, Prof. Richmond. Prof. Bishop, were you going to say the same thing?
Please.
Okay. Prof. Alexia, I wanted to hear your side of the whole thing.
Sir,
Yes.
please, I'm not really sure, but I think it will increase the asset,
Okay.
the computer, but decrease the cash.
Okay, good. So you are all right in your presentation of what you contributed regarding this scenario. It is very simple. If Prof or business Alexia goes to the market to buy a computer, you see, business Alexia is getting a computer. So computer as an asset in the business is going to increase. However, since the business paid cash, so it means that money is going out of the business. So the money is moving from the business to Malcolm. So the business is also going to lose another asset, which is cash. Now, I gave this scenario to suggest to you that business transactions have impact on the accounting equation. In the scenario I just said, you are seeing that one asset is increasing, that is the computer, and another asset, cash, is decreasing. Now, the other element of the accounting equation, which is capital or liability, could also have same impact depending on the transaction that is occurring. So this is what we are going to discuss into detail because that will enable us pursue the double entry principle. So on the background that now you appreciate that a transaction can affect an asset, a liability, or capital, let's look at what the double entry principle is. Okay. Now this is what the double entry principle states. So you can put it down in your notes. The principle states that for every debit entry, there should be a corresponding credit entry and vice versa. Vice versa here means that for any debit entry or any credit entry, sorry, there should be a corresponding debit entry. This is the principle. Now, who even brought this principle? Yes, let me ask my student if they know the person who is behind this principle. Yes, any idea as to who designed this principle for us in financial accounting? Okay, so the person behind this is called Luca Pacioli. Luca Pacioli. You can note it down because it can be asked in an examination. Who is that person who designed the double entry principle? So his name is Fra Luca Pacioli. The Fra is a title for monks, like the way we have doctors, professors. His is Fra. Fra is a title for an Italian monk. So his name is Luca Pacioli. Okay, he was a trading merchant and also a monk in Italy years ago. Years ago. So he designed this double entry principle. As such, he is known to be the father of financial accounting. The father of financial accounting, Luca Pacioli. So this is what Luca Pacioli said, that for every debit entry, there should be a corresponding credit entry, and for every credit entry, there should be a corresponding debit entry. Now, if you read it like that, it doesn't make sense. So let's try to make sense out of it. What Luca Pacioli is trying to say manifests in the scenario that I gave, that when a transaction occurs, you seek to see two effects, right? Two effects. One element may increase, the other may decrease, or sometimes both of them may increase or both of them may decrease, right? Oh, I think I just lost Prof. Richmond. Wow. Regardless, let's continue. Okay. So if we critically analyze Luca Pacioli's principle, it says that I think we'll bear with this. We'll bear with this network interruptions since it is something that is being resolved. Okay. So let me continue. Okay. So we're looking at the double entry principle. My screen will load shortly so that you can all have access. Good. So please, if you are asked to state the double entry principle, please tell them that for every debit entry, there should be a corresponding credit entry. And for every credit entry, there should be a corresponding debit entry. That is the principle. But if you want to explain further, then what it means is that if a transaction occurs, there are two entries that are to be made in two accounts. So two entries to be made in two accounts. So we are getting some new terminologies here. Two entries. So what is the meaning of entries? We'll come to that. And then in two accounts. So what is an account? We have to know that. Now, one of the entry you have to make is a debit entry. And then the corresponding entry you have to make is the credit entry. So we have to pick these terms and also explain them. Okay, good. So the principle is saying that when a transaction occurs, you have to make two entries. These two entries are a debit entry and a corresponding credit, or vice versa, a credit entry and a corresponding debit. Where do you make these entries? In an account. So it means that it's important for us to know what an account is. So I don't know if one of my professors will read what I have here as an account for us. Who is going to read this for us? Prof Richmond, can you do the reading for us? An account.
An account is a ledger, summarized record of a business transaction. It is a record in an accounting system that monitors the financial transactions associated with a specific asset, liability, equity, source of income, or outlay. As the business event takes place throughout the course of the accounting period, these records grow and shrink. At the conclusion of an accounting period, financial statements are created using the accounts that are kept in a ledger. The following columns and characteristics are present in an account. An account is split through two sides. 1. The right side for the credit side. 2. The left side for the debit side.
Okay, thank you very much, Prof. Richmond. So I guess we would continue by looking at the characteristics as given. Is a ledger summarized record of a business transaction. So what does it mean? It means that we know business transactions, examples to be sold goods to Kwame 50 million. So this statement, long statement, sold goods to Kwame 50 million, we can summarize it and record it in what we call an account, right?